a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
We are going to talk about the first zero-fee ETF with our ETF Research Director, Nina Mishra. And you just did an interview regarding this company whose primary market seems to be millennials.
Right.
Who's now offering a zero-fee ETF. I guess this was just a matter of time before we started seeing this, right?
Right. So on Monday, we learned that social finance, popularly known as SoFi, and they have filed for what would be industry's first zero-fee ETFs.
Right.
These two ETFs, SoFi 500 ETF, ticker SFY, and SoFi Next 500 ETF, ticker SFYX. They actually have expense ratio of 19 basis points, which would be waived for the first year, maybe extended or maybe not extended, but the waiver would make them free for investors during their first year, at least.
And do these contain socially responsible companies? Is that the point?
No, these are broad market ETFs.
Okay.
They will be holding large cap and mid cap US stocks, but they will be weighting and selecting stocks based on certain growth factors.
I see.
Like earnings growth and other growth factors. So we knew that a zero-fee ETF is coming very soon. It was a question of just when, not if. And that we knew because last year Fidelity had launched 4 zero-fee index funds. And they had become very popular. Initially, at least, they were able to gather about $3 billion in assets under management within a few months of their launch. And after that, the interest has kind of been flattish. But of course, free is free, and they generate a lot of buzz, at least initially.
Yeah, well, that's what everybody thinks. Free is free. We're going to get into that.
Yes.
But this is a relatively smaller company than we're used to seeing
exactly
on the index fund scene, and they provide some competition to the big guys, right?
Right. So fee wars in general have been heating up in the fund space, but it has been the bigger providers like BlackRock, Vanguard,
right.
Charles Schwab, Fidelity,
right.
Of late JP Morgan too, then State Streets, which have been very aggressive in cutting their fees in order to attract investors' cash, and investors are becoming increasingly cost sensitive. They have been putting their money in the cheapest funds, and that is why the providers have been cutting their fees. So it was a surprise that the first free ETF came from SoFi, which is a new entrant, which would be a new entrant in the ETF world. But it makes a lot of sense because it was a great PR move for them.
Sure.
It gave them a lot of publicity and publicity about their upcoming ETFs. JP Morgan has filed for an ETF, and JP Morgan has been very aggressive in the ETF space over the past year or so, and it is being speculated that that also is a free ETF, a zero-fee ETF, but we will see when it launches.
All right, take us through some highlights on commission-free trading of ETFs.
So, as I mentioned, that fee wars in the ETF space, in the fund space, have been escalating. And this is another front. All the bigger providers, all the bigger platforms have been aggressively cutting commissions on ETF trading. Vanguard, which is the low-cost leader in this space, they announced commission-free trading on almost all ETFs except leverage and inverse ETFs, which they say are not in line with their long-term investment objectives. So about 1,800 ETFs are available for commission-free trading on Vanguard platform since last year. Then last month, Charles Schwab and Fidelity, they more than doubled the number of ETFs that are available for commission-free trading on their platform. JP Morgan has a U-Invest trading platform, which has free stock and ETF trading, but that has certain minimum balance requirement. So this is another area where wars have been heating up and investors have been the biggest winners.
Sure. All right. Now the $64,000 question. Is free really free?
Yes. So when you look at the costs, and costs are important factors to consider when you select an ETF or a mutual fund, but costs matter a lot when you are comparing an ETF charging, say, 60, 70 basis points versus an ETF charging 5 or 10 basis points.
Sure.
Costs become meaningless when it comes to a few basis points. We have many ETFs that charge less than 10 basis points, which means 10 cents for every $100 invested.
Okay.
So if you are comparing 3 cents, 4 cents, a difference of 3, 4, 5 cents for every $100 invested, that is totally meaningless. It does not impact your returns in a meaningful way. So any ETF that charges 3, 4, 5 basis points, I say that is as good as a zero fee ETF. And in addition to costs, you should also look at other costs. In addition to expense ratio, you should also look at the other costs, like trading costs, whether it is available for commission-free trading, whether it is liquid enough, and
That's important.
Or it has if it is not liquid enough, it would probably have a high bid-ask ratio, which would increase your trading costs. And then there are tracking errors to consider. How closely is your fund or ETF tracking its index? Now there are certain companies and certain fund providers which have very good securities lending programs. So they lend out these securities of your funds to short sellers and earn extra income. Vanguard in particular has some funds which through securities lending generate extra income, and they are like more than free to their holders. So those are certain areas that you should look at, not only at the zero fee expense ratio, zero expense ratio. And in case of these two ETFs, remember that they have expense ratio of 19 basis points. So investors considering those ETFs should remember that after a year, waiver may continue. They may reduce the waiver, or the fund may go back to charging 19 basis points.
All right, so when you're talking free, there's a lot more to consider than just that word,
Yes.
free.
Yes.
All right, now viewers always like to see a couple of examples, and you have a couple to share.
So as I mentioned, ETFs charging 3, 4, 5 basis points are as good as zero fee ETFs, particularly if they are ultra liquid, resulting in very low trading costs, low bid-ask spreads. So I have two ETFs which are very low cost, ultra cheap, very liquid, highly liquid, so low trading costs, and they provide exposure to the entire US equity market, and they are very good for your core portfolio.
Okay, let's look at them.
So the first one is by iShares. It's core S&P Total Stock Market ETF. The ticker is ITOT. It tracks it tracks the broad U.S. equity market, all securities, large, mid cap, and small cap. You can look at the details on quote page on Zacks.com. As I mentioned, expense ratio is just 3 basis points, and nice dividend yield of 1.9%. You can go to external homepage and look at other details and holdings. In fact, this holds 3,350 stocks, so very,
Wow.
very diversified ETF.
Is that abnormal for the number of holdings? or not?
Because it provides exposure to the entire U.S.
I
equity
see.
market, so it includes all large cap, mid cap, small cap stocks, everything.
I see.
So that is why it has so many holdings, but you get exposure to all the holdings in one wrapper.
One, yeah.
So that is the advantage with this ETF, and as you would expect, Microsoft, Apple, Amazon, Facebook, and Berkshire Hathaway, all industry giants, they are the top holdings in this ETF.
Okay, what's in the next wrapper?
So this tracks the S&P 500 ETF, ticker IVV. This is also ultra cheap, just 4 basis points, and with $160.5 billion in assets under management. This is highly liquid ETF. So if you do not want exposure to small cap stocks or not to too many stocks, then this is the ETF to consider, because it provides exposure to the large and mid cap US equity stocks. And you can go to the quote page on Zacks.com for this ETF and read our research report. 4 basis points expense ratio, about 2% dividend yield, and you can go to external homepage for this ETF and look at the holdings and other details. So as you would expect, again, Microsoft, Apple, Amazon,
Sure.
Facebook, all
The
the
big
top,
ones.
all the big ones in the S&P 500 index are the top holdings in this ETF too.
I just had another question
Sure.
about the previous ETF that you talked about. When you're exposed to 3,000 stocks, many different sectors of the market, in your opinion, does that dilute the product too much?
So if you want to get a very diversified exposure, then it is a very good product, because diversification largely eliminates single company risk. And if you take S&P 500 ETF, this doesn't provide exposure to small cap stocks. So if you have an S&P 500 ETF also in your portfolio, then probably ITOT is a good product to look at to gain additional exposure to small cap stocks as well,
Interesting.
at a very low cost.
Okay. Do you own either one?
I do not.
All right. Always interesting information when it comes to ETFs from our research director, Nina Mishra. There's also more ETF information in that section of our website, Zacks.com. Use the Funds tab in the top toolbar to help guide you to that section. With Nina, I'm Terry Ruffalo.